You see a headline, right? A company's profits are through the roof. But have you ever stopped and thought, hang on, are those numbers even real? It's a great question. And today, we're going to pull back the curtain and find out how we get that answer. We're going to look at the anatomy of a financial audit, and we'll do it by telling a story.
All right, let's meet the star of our story today, Sunrise Electronics. They sell phones, all sorts of gadgets, and let's just say business is absolutely booming. On paper, they look like a total rock star company, growing way faster than anyone ever expected.
So the directors released their financial statements, and the first number that just jumps off the page is their revenue, a cool $50 million. I mean, for a company on the rise, that is a seriously impressive number.
And hey, it gets even better. From all that money coming in, they're reporting a really healthy profit of $8 million. Now that is the kind of number that makes investors very, very happy.
And the cherry on top, they've got $4 million in cash just sitting in the bank. So you've got strong revenue, great profits, and a ton of cash. Sunrise Electronics looks completely unstoppable. The numbers look fantastic. But, and this is the big but, how do you really know they're real? How can anyone, investors, banks, you, and me, be sure that these numbers are the real deal? And that, right there, is where our story truly begins.
Well, it really all boils down to one simple, fundamental issue, a problem of trust. And you know what? Solving that problem is the entire reason the auditing profession even exists.
This all comes down to a core concept called the separation of ownership and control. It sounds a little academic, but it's actually super simple. Think about it. The shareholders, they're the ones who technically own the company. But they aren't running it day to day, the directors are. And since the directors are the ones preparing the numbers, well, they have a natural incentive to make the company look as good as possible. That's why the owners need an independent third party to come in and verify everything.
You know, a really great way to picture this whole thing is like a courtroom drama, but for business. And in this little drama, we've got 3 key players, and each one has an absolutely crucial role to play in this financial investigation.
So first up, you have the responsible party. In our story, that's the directors of Sunrise, the ones who prepared the financial statements. Second, you've got the intended users. That's the shareholders and investors, the people who need to rely on that information. And third, you have our practitioner, our independent expert, our detective in this case. We'll call him Mr. Ahmed, the auditor.
So, Mr. Ahmed doesn't just show up at Sunrise Electronics and start flipping through random papers. No way. A real audit is a carefully planned investigation. It's like a strategic mission with a very clear objective.
And this quote right here, it gets to the very heart of the auditor's goal. Notice what he says. His job is to collect enough evidence to determine whether the financials give a true and fair view. He's not saying his job is to guarantee they're 100% correct or to check every single transaction. His mission is to gather enough proof to form a professional opinion. That's a really important distinction.
So where does he start? By thinking like a detective and sniffing out the biggest risks. For a company like Sunrise selling small expensive electronics, inventory is a huge risk area, right? It could easily be stolen. Another big one is revenue. Could someone be recording fake sales to pump up that $50 million number? He's got to focus his efforts where the risk of things going wrong is highest.
So with those high-risk areas identified, Mr. Ahmed and his team begin the hunt for some hard evidence. This is where the detective work really kicks into high gear.
And auditors have a fantastic toolkit for this. For inspection, they'll actually look at invoices and contracts to make sure the sales are real. For observation, they will physically go to the warehouse and watch the staff count inventory. With confirmation, they'll send letters directly to customers asking, hey, do you really owe Sunrise this much money? And finally, recalculation, which is just good old-fashioned checking the company's math to make sure it all adds up.
Okay, so this brings us to a very common and very fair question. With potentially millions of transactions, is it even possible for an auditor to check every single one? The short answer, no, absolutely not. Trying to check millions of sales would be an impossible task. It would take years. So instead, auditors use a much smarter approach called sampling. By testing a small but representative sample, let's say just 200 sales out of millions, they can gain a high level of confidence about all the transactions. This goal is what's known as reasonable assurance.
So, after weeks of investigating, testing, and gathering all this evidence, the team is ready. Now it's time for Mr. Ahmed to weigh everything and deliver his final verdict.
And ultimately, it comes down to 2 main outcomes. On one hand, you have an unmodified opinion. This is basically a clean bill of health. It's the auditor saying, yep, based on our evidence, these numbers look true and fair. On the other hand, you could get a modified opinion. This is a red flag. It means the auditor found a problem and is saying, everything looks good except for this one specific issue we found.
So, what's the big takeaway from all of this? Maybe the best way to remember the true purpose of an audit is with one final, simple analogy.
Think of an audit as a health checkup for a company. A doctor examines a patient using tests and scans, then issues a report on their health. An auditor examines a company using audit procedures and then issues a report on its financial health. And just like a doctor can't guarantee you'll never get sick, an auditor can't guarantee a company is perfect. Both provide reasonable assurance based on the evidence they've gathered.
So an audit isn't a guarantee against all problems, but it is the absolute bedrock of trust in our financial system. It gives everyone confidence in the numbers. Which leaves us with one final thought. If an auditor's job is to provide a professional opinion, where does their responsibility end and a company's fundamental responsibility to just be honest begin? It's something to think about. Thanks for joining this explainer.